Welcome back, class. We're going to kind of wind this chapter up, chapter 10 up with the fourth segment. We're going to talk, and it probably won't take a long time to go through it, but we're going to talk about the Federal Reserve System. Um, and the Federal Reserve System is the same thing as in um, every global economy has a central bank. And even the European Union has central banks. And the central bank for the United States is the Federal Reserve System. It's a bank that acts as a banker to the central government, acts as a banker to banks, conducts monetary policy, acts as a regulator of banks, and supports the stability of the financial system. So if you think about that in general, it is functions similar to multiple central banks scattered across the global economy. Because again, for the most part, central banks act as a banker to the central government, acts as a banker to banks, acts as a regulator of banks, conducts monetary policy, and supports the stability of financial system. And especially when we talk about the monetary policy, we're going to have an entire section or an entire chapter in this text talking about monetary policy. But central banks, that is, I don't want to say it's their mission, but it is typically their charge across, for the most part, most global economies in the world. And our Federal Reserve or our central bank was generated or brought forth by the Federal Reserve Act of 1913. And when we want to talk about the structure of the Fed, it is independent of the government as much as possible. Now, the Central Bank of the United States is, for the most part, independent of the government, directly independent of the government. It's not that way in some countries where the government tries to control the central bank, or the central bank and the government are one and the same, and there's no separation of powers. But it is here in the United States. You're trying to avoid too much central power in the way the Federal Reserve is the mandate of the Federal Reserve, because there are 12 regional banks. And if you go to the text, they have a map of the United States drawn out, and it shows you which states are covered by those central banks. It's a bankers cooperative owned by commercial banks in their district. It's based on governors. So the board of directors for the entire system, there are 7 members appointed by the president and confirmed by the Senate. So this is the board of governors. They are staggered 14-year terms. So because they're 14-year terms, no one president is going to be able to control them, because remember, the president of the United States is only going to serve at most 2 4-year terms. So they are staggered 4-year terms. The president appoints the chairman for a 4-year term. They can buy and sell federal government bonds, not part of the federal government, even though they can buy and sell federal government bonds. And Congress can try to influence, but it can't order. And that is a key concept with the Federal Reserve. Congress can try to influence, but they can't order the Federal Reserve, at least under the current mandate. And the main thing it does, because it is segregated from government interaction, is it eliminates the congressional budget issues. I mean, we're in the middle of a congressional budget issue now. They can't even agree on a budget. They just keep extending it. Everybody's so afraid that the government's going to shut down. Well, okay, big deal. I work for the ERS, the Economic Research Service, when I got out of graduate school from Ohio State. And it was the analytical arm of Department of Agriculture. And, I went through, I was only there a little less than 3 years, but I went through a couple of potential government shutdowns. And okay, it's not that big a deal. The ERS was not considered um, a one of the I guess services of the government that was mandatory. So they were talking about severance, and some of us talking about having us work only work 2 days a week or 3 days a week. But the government actually ended up getting their act together and approving the budget. But it seems like it's an annual process. The government, can't ratify, can't agree on a budget, can't get their act together. The powers of the Federal Reserve, the power stems from authority to conduct monetary policy, and that is probably their true authority, is the ability to conduct monetary policy. And monetary policy, they do that by adjusting the supply of money and credit. So that's where you're going to see the Federal Reserve. So you've got within the government, you got monetary policy, which the Federal Reserve drives, and then you've got fiscal policy, which the government itself drives. And there's, let's see, monetary policy, maybe in your text, maybe it's chapter 12, and fiscal policy, maybe chapter 13. I don't know. We'll eventually get to that in the course, though. The policy tools, they set the reserve requirements. They set the percentage of the reserve requirement, reserve levels banks must hold against their deposit liabilities. Remember, little r's, RRR, required reserve ratio. The Fed sets that required reserve ratio. It's been approximately 10%. And we talked about it earlier, if you decrease the reserve requirements, what does that do to the money supply? It increases it because it has more money that can flow out into the money supply, work through the system with that multiplier we talked about, and then it's going to just overall increase the money supply. And if you increase the reserve requirements, so if you increase the level of reserve requirements that the banks have to hold, it's going to decrease the money supply. Remember, contrary to each other. Very important piece of information, especially once we get into the chapter talking about money supply. The Federal Reserve as a policy tool also manages the discount window and other credit facilities. Its primary responsibility at the creation of the discount rate. The lender of last resort for banks strapped for cash. So if banks get in a bind for cash, the Federal Reserve is kind of the lender of last resorts for banks that are strapped for cash. And typically it's banks that have made some bad loans, or banks that have overextended their loans, or there maybe have been a run on a bank where, again, remember, for the checkable deposits, you as a depositor have immediate access to that. So there are a multitude of things that can cause the banks to have financial issues, and the Federal Reserve is going to be the lender of last resort for them. The discount rate, it's the interest rate charged by the Fed when it lends reserves to banks. So see, remember, the Fed serves as a bank to banks, to other banks. And so they can use some reserve dollars to loan to other banks. And that's what the discount rate is. That's an interest rate that they charge to other banks. Each district bank has the power to set its own discount rate, usually a uniform rate set with guidance from the Board of Governors, which makes sense. But remember, those 12 district banks can actually set their own discount rates, even though the Board of Governors try to keep it a uniform discount rate across all of the district banks. If you decrease the discount rate goes down, potentially money supply goes up. The discount rate goes down. Other banks are more, it becomes more attractive to borrow money to the Fed and turn around and loan money out to borrowers. So discount rate goes down, money supply goes up. Discount rate goes up, money supply goes down. Again, remember that inverse relationship between the discount rate and the money supply. The federal funds market is a market in which banks lend reserves to one another. So I'm not even sure what banks are in the Nashville area, but here we've got Bank of America, we've got Chase, we've got Truist, and they lend money to each other through or via the federal funds market. And they use that instead of using the Federal Reserve. The Fed funds rate, it's an interest rate charged when one bank lends reserves to the other. So that's going to be your federal funds rate. So you've got a federal funds market, you've got a federal funds rate. The rate is the rate that banks charge each other, and the market is the market in which banks lend reserves to one another. If you increase the Fed's new reserves, it actually decreases the federal funds rate. And if you decrease the Fed's new reserves, it's going to increase the federal funds rate. And then one other concept that the authors put out there is the discount rate equals the federal funds rate plus a half a percentage point. So the discount rate that we talked about earlier equals the federal funds rate plus a half a percentage point. Make sense? Actually, plus 0.05% is, so the federal fund rate plus 0.05%. And then another policy tool is the open market operations. And it's maybe the most potent of the policy tools that the Fed has when it talks about monetary policy. They can buy and sell government bonds. And this is one of the ways that they control the money supply. Bond is a promise by an insurer of the bond to pay the owner of the bond a payment or a series of payments on a specific date or a series of dates. Open market operations, the buying and selling of federal government bonds by the Fed. So the Fed can, through their monetary policy, if they see a opportunity or they see a requirement to manage the money supply either up or down, can decide through the open market operations to either buy or sell government bonds, and it can have a significant impact on the money supply. If the Fed, when we're looking at the Fed's activities, if they're buying bonds, it's increasing the money supply because money's going out. If they're selling bonds, it's decreasing the money supply because money's coming back into the Feds. Make sense? Buying bonds increases money supply, money going out the door. If they're selling bonds, money supply is going down, money's coming back in the door. The Federal Open Market Committee, and you see it in the text a lot, and you actually see it in the Wall Street Journal and other financial, documents and publications, the FOMC, the Federal Open Market Committee, and they're the ones that are going to drive those open market operations. And then another policy tool that the Fed has, and it's not nearly as important as the open market operations, but it's paying interest on reserves. So banks are funding reserves into the Fed, and they're, that 10% that they have to hold in reserve. Because of the Great Recession, the Fed started paying interest on banks, on a bank's reserves, the required and excess. Most potent tool in the Fed's arsenal is it's the increase or the decrease of the federal interest compound rate to the market rate. So if you increase the rate of the federal interest rate compared to the market rate, it decreases the loan activity for banks. Make sense? If you increase the federal interest rate compared to the market rate, it's going to decrease the loan activity for banks. Banks are going to make more money by putting reserves into the Fed than they are on the open market. If they decrease the Fed's interest compared to the market rate, it's going to increase the loan activity for the banks. So think about it as the banks can make more money keeping their excess in the Federal Reserve at the federal interest rate than they can on the money market rate, they're going to dump the money into the Fed and decrease the loan activity that they're loaning out to borrowers. And that pretty much wraps up chapter 10. A lot of I guess activity or a lot of concepts covered in chapter 10. And I think in chapter 11, we're going to talk about maybe it's financial market. Maybe we're going to continue on the financial markets, and that's going to be 11. And then maybe 12 is monetary policy, and then maybe 13 we get into fiscal policy. So the next time we get together, we'll be talking about financial markets and the economy, and why financial markets are there, and what it means to not only investors, but what it means to profit maximizing entities. Talk to you next time.